Hello and welcome back to the Simplifiers podcast, where we take topics in work and in life and simplify them. And friends, I am so excited about simplifying today's topic because we hear every now and again from our listeners, and they say, Mary, please, would you just please find the right expert to simplify this particular thing? And that, my friends, is how to buy a house in a post-pandemic world. Yes, we are going there today and really digging in and asking all the quote-unquote dumb questions just to equip you if you are thinking about buying a house in the next 3, 6, or 12 months ahead. So my special guest today, his name is Joe DiSanto, and he has built multi-million-dollar businesses. He's produced critically acclaimed documentaries and an Emmy-winning TV show. He's also, though, invested millions in real estate and semi-retired at 43. Now, he serves as a fractional CFO for several creative firms and is sharing a lifetime of fiscal know-how through his new company, Play Louder, an invaluable resource that helps individuals and business owners increase their net worth and plan better for their future. So, I'd like to welcome to the Simplifiers podcast, Joe DiSanto. Hey, Joe.
Hello, how's it going?
It's good to see you, and I'm glad you're here. And
absolutely, thanks for having me.
Maybe I'm a bit optimistic to say that we are buying a house in the post-pandemic world because I don't know if we're ever going to be post, or at least not in the next couple of years. However,
it's almost like the new world, it seems like now.
Well, I mean, it is. However, if anybody has been watching the news or not been hidden under a rock lately, just about everywhere in the world, the housing market has gone bonkers. I mean, absolutely bonkers. And there seems to be a few theories out there as to why. One is, now that pretty much the global world had to go work from home, major corporations are like, well, people can work from home now. And so people are like, well, if I have a job in San Francisco, but I can work from home, then that means I can go live in the country where it's 3 times cheaper. And maybe people are moving because of that. Maybe parts of that. But then also, I imagine people are going through that process of like, holy crap, we're all working from home. I need space, or I need an office in my house. I need to find a different place to live. So, what are your thoughts on all of that? Why do you think there is such a craze right now in the real estate industry? And maybe let's just focus on the U.S.
Well, I think those reasons that you mentioned definitely are contributing factors for sure. It's interesting, though. I mean, part of the reason also I think that the prices are so high, in addition to the things that you mentioned, which really take people more or less out of the bigger cities and the more expensive markets, and they distribute them out to like the kind of suburbs, or even a few hours of a perimeter around a big city where houses actually do get significantly cheaper.
Right.
But it's also pushed them even further, to migrate to a whole different city that might be like significantly cheaper. But the irony there is a lot of people are doing that, so it's driving up the prices in what used to be kind of more reasonable markets. Now, What's confusing to me is that you would think, okay, well, that all makes sense. So shouldn't the prices in the expensive markets be going down? But they don't seem to be going down anymore. I mean, I used to live in Los Angeles, and most of my clients are there, and the housing market there seems to be hotter than ever also.
Yeah.
Now, I had heard for a while that San Francisco prices were sort of on the decline for the first time in decades. But the last I read, it seemed like it was turning around there as well. And then the only place that maybe has, had some reduction in price that's been maintained is New York, so far as what I've read and talked to friends that live in New York. But it's not super significant. So I'm still a little confused by that, but I think part of the other reason that you're getting price increases kind of across the board in multiple scenarios is from the stimulus. People have more cash actually at their disposal, so they can put higher down payments, and that can get them to commit to a higher purchase price. Combine that with the fact that interest rates have been driven, low, some say artificially low, and been maintained at those extremely low levels. So when you have low interest rates, people can basically afford to pay more or buy more house because their monthly payment's going to be, relatively less because of the interest rate. So all in all, those factors have added significantly to prices. And I guess the last factor that I didn't mention that I'm thinking about is I live in Florida now. I moved to Florida 3 years ago. And just in the 3 years I've been here, in my area, the prices of houses have just gone bananas. The first house we bought here that was a rental, it's almost doubled in price in 3 years, which is nuts. Now, part of the reason for that is Florida is both a destination for young people and families because Tampa, my area, definitely code-aside is growing and more business is happening in Tampa and people are coming to Tampa for work. But they're also coming to Florida retirees that decide, hey, I'm just going to cash out early. I'm going to quit because of COVID. I'm going to sell my house that I've owned for 25 or 30 years in New York or New Jersey, sell it for $1 million. Pretty much I have a ton of equity in it, come down to Florida and pay all cash for a house or pay if not all cash, a 50% down payment or a 30% down payment and essentially a very competitive offer. So that's yet another factor that's driving prices is people retiring and migrating, that aren't going to be working anymore. But that's happening more in the Florida area, Texas, places in the South, places that don't have state income tax. Retirees tend to like to go to because they want the retirement income to be, taxed less for obvious reasons. So it's challenging. I mean, I have to say sometimes though I think about it and I'm just like, even with all those factors, it's just I don't know that people are making on a percentage basis that much more money, on average. So it's like, how are so many houses so expensive? Where the majority of the population isn't making a wage that could support, those home prices. That still sort of eludes me, that fact. But I'm not an economist, so,
Well, and I
stop there.
The average layperson, I think that we all just feel a little bit frustrated by the what's going on right now. Because like you see houses on that are listed and within 24 or 48 hours having multiple offers, upwards to $50,000 to $100,000 over asking price. And, I can imagine there's quite a few of our listeners that are, first-time home buyers or maybe second home buyers and going, well, I can't even compete. Like, how could I possibly? Because, that requires another 50 or 100K that I'm approved for in a mortgage or cash for a down payment. And that's just not possible.
Talking about how expensive housing get is definitely like a little bit of a sad topic, I think. But, to that point, though, I will say that every time I've bought a property in my life, I feel like, except for maybe two of them, it was the top of the market when I bought them, and I was saying to myself, man, it's just, should I buy this thing? It just seems so expensive,
Right.
And it all worked out, everything, housing, like, the stock market on the average over the long term has had a very consistent rate of appreciation. And it probably will likely to continue to have that. Will it have some potential short to midterm setbacks? Potentially, it's anyone's guess. I don't think we're in the same kind of scenario like we were in 2008, where the prices were just propped up by essentially untenable loans. The lending requirements and underwriting requirements these days are still pretty stringent. They've loosened up a little bit since like 2010. Where it was just like really hard to get approved for a loan. But they still put you through the ringer, I have to say. It's not like, the Wild West days of 2007 where you could just like tell them how much money you made, provide no paperwork, and they would just give you a loan pretty much, straight away.
Well, I want to go deep into this in particular because I know we have a lot of small business owners that are listening. So how to even get approved for a loan. We're going to talk about the how about that in just a second.
Sure.
But I guess backing up, imagining pandemic aside, if you can, what is the first thing that anyone should be doing when they're thinking about buying a house? Like, what's the first step that you advise your clients with?
Well, the first step is you do have to basically have just a plan of like generally how much house you think you can afford, and then that is sort of determined by your available down payment. Okay. Um, and if you're a first-time home buyer, I mean, it's one of the greatest things to be because you get access to lower down payment options as a first-time home buyer. And these programs have been around for a long, long time through the FHA or Federal Housing Authority. And you can get into a first-time home buyer loan for as little as 3.5% down. I believe that is still the case. Now, if you're that low of a down payment, or essentially what's called the loan to value, you might have to pay like private mortgage insurance or PMI. So basically it's a small additional monthly payment that would kind of covers the bank, because the bank generally likes to have at least, have you at least have 20%, cash in the property because it covers their downside.
Right.
So if you only have 3.5% equity in the property, they're like, all right, you can take a little insurance policy, essentially, pay an extra $60 a month. And if you default, we can get money out of the insurance. So that's how that works.
So wait, the loan to value is an insurance policy or just an additional loan on top that you pay off a bit?
The loan to value essentially is just a term that indicates if you put 3.5% down, right?
Yep.
That would mean you have a 96.5% loan versus the value of the house.
Right.
So your equity in the house is only 3.5% of the house value. When it's that low, banks generally, the general term is they'd rather you be putting 20% down at least, because it gives them a lot of buffer for the house value to go down, without them being in the red.
Right.
So with only 3.5 buffer for them, they're like, it makes me nervous. We'll do it for the first time home buyer because FHA will give you mortgage insurance that you can pay for and put us as the beneficiary. So if you default, we can go to the FHA and get our money or get the money that we're missing. So it's called private mortgage insurance, or commonly referred to as PMI. And if you're going, if you get in for a low down payment, you'll probably have to pay some PMI on top of your other monthly expenses for the house, which is principal, interest, taxes, insurance.
And by the way, anybody that's listening right now and you're thinking, oh my God, Joe's throwing out lots of stuff right now. Well, we've got you covered. Everything that we talk about is going to be found in the show notes over at thesimplifierspodcast.com. So yes, have your pen and paper out, but know that everything that we talk about today, you can find the links for at the show notes.
Absolutely.
Okay, good.
And I'll try to not go so deep in the technical terms.
No, go deep, because I'll just ask, and I'll be the guinea pig and ask all the dumb questions. So
let me hop back though before I lose my train of thought. So if you have $25,000 down payment, you would potentially be able to afford a $500,000 house with a 5% down payment. So if you're buying a $500,000 house, 10% down payment would be $50,000, 5% down payment would be $25,000. So you can see at that low of a down payment, you can actually, get into a pretty decent sized house or, value house with a relatively small down payment. So, and that's by design. America basically incentivizes the citizens to own property. It believes that owning property is good for the country for whatever reasons. I mean, there are the reasons I think, and I think they probably think too. But they want you to do it. So they basically created, a mortgage insurance situation so you can get into a low down payment loan. They also incentivize you to do it by giving you great tax incentives by owning property. So we'll get into all the reasons why I think owning a house is good, and a lot of the incentives that the government throws at us to do it are part of the reasons. So now that okay, well, I have $25,000. If I get in for 5% down, maybe I could buy a house for $500,000. So the next thing is, well, can I get approved for a loan for $475,000? And there's only one way to find out, is to apply, And I always say to people, don't wait. If you're even thinking that you might want to buy a house, but you're not sure, just don't wait. Just go get pre-qualified. It's free to do. And the lender doesn't know if you're truly ready to buy a house today or in 6 months or in a year. And honestly, they don't care. They'll pre-qualify today, and if you buy it in a year, super. You're in their sales funnel, so to speak.
Sure.
I also say go look at houses. Like it's kind of fun actually, at least at the beginning. After 6 to 8 months of like failed offers, it actually starts to get a little bit tedious. But in the first few weekends, it's actually super fun. And it's like when you do that, when you go get pre-qualified and you sort of get yourself in the mode, then you like find a realtor and you say, listen, I'm looking at buying as soon as I can. But I'm assuming it could take up to a year because we know how the market is. They're not going to be able to argue with you. All they're going to want to know is, are you pre-qualified, and do you have that down payment in the bank that you're telling me you have? Because they don't want to waste their time. So hopefully you have those verifications for them, and then go look at houses and see what's out there. And I always found like when I started out, I bought my first property at 28, but like I was looking to buy a house since I got out of college. I don't know why exactly. I just liked real estate. It seemed like a good idea to me. And I honestly went looking. I got a realtor, and at that time they didn't really like sweat you too much for a pre-qual letter and your down payment. It wasn't as competitive, I guess. I literally made no money though, so the chance of me buying a house was like next to none.
Yeah.
But when I did it, it really got me excited, and it just got me on the path, and it's like I committed to it even more so in my mind once I was kind of looking. And I started to imagine myself in my own place where I could do the customizations I wanted and, just have fun with it, paint the rooms the color I wanted without having to ask anybody. I could have a dog without having to ask anybody. I didn't have to sweat the landlord showing up to fix the toilet and seeing the dog I wasn't supposed to have. And, just all those things. And I tell you, like once you buy a house and like you're in it and you experience all those things and you also experience the pride of ownership, like anyone that I've encouraged to buy a house that finally did it, like was super happy about it. They just really liked it, and from a long-term sort of family perspective, that one of the things I think is most important about owning your house is you can't be kicked out of it. It as a renter, if your lease expires, you can just be kicked out at the owner's whim. And in a rising, market such as there is now, and people can cash out of their houses, they're very likely to not renew your lease. And if that's like your home and you have kids even, and it's like that's your settled place, I can't imagine anything more unsettling than having to just be forced out of the place that you live.
Especially if you are renting a house in a specific zone for, say, your children's schools.
Yes.
And all of a sudden you're scrambling to find another house, then can't find it because the supply is low of rental properties and that. So then that means your children are having to be sent to a different school, stripped away from their friends. I mean, it's a much deeper, layered, stressful situation. I want to recap what you said earlier because I really want to make sure it's clear. Like the 2 steps that you need to do well in advance, obviously before you even put an offer on a house, is 1, figuring out your down payment amount, cash amount in bank or in your savings account that you have ready to go at any point, right? Step 2 is getting pre-qualified for a loan right now, even if you're not buying for another 6, 9, or 12 months out. Let me ask you about that, though, because if you were to go down that path and get pre-qualified, does that bing your credit score or your credit report in any way? Or, is there any negative consequences to getting pre-qualified now?
Yeah, it's an inquiry on your credit report.
Yep.
Sometimes they tell you that if they do a soft inquiry for a pre-qualification, it won't give a ding. But eventually, when you go for final qualification, it'll certainly be a hard inquiry. But it's like that's a pretty minor ding on your credit. I mean, that's not going to affect your credit that much. If you have like 12 dings in a year because you've applied for so much credit cards, this, that, and the other,
right?
Then
Red flags.
that'll hurt your credit a little bit. And you get a certain amount of dings from lenders in a certain time period that won't negatively affect your score because you have the option to shop your loan. You want to talk to a few lenders to try to get the best interest rate.
Right. And that was my next question.
Yeah.
So should you get three pre-qualifies, three different, lenders and just see which one has the most competitive rates or the most ability to loan?
Yeah, well, this is a good topic, and I know a lot of your audience are business owners and entrepreneurs, and they don't have the regular W-2 paycheck. And one thing I run into a lot with people I talk to, because I have my regular kind of retainer clients and so on, but then I just kind of coach people. They find me on my website, and we just do intermittent sessions or whatever. And they're always like stressing, like because maybe we're talking about them starting their own business, right? And going off their W-2 paycheck. And they're like, well, I hear though, I might want to buy a house. And I hear like it's really hard to get approved for a loan if like you don't have a W-2 pay stub.
Sure.
And I want to debunk that myth. I will say, that certain kinds of lenders, like the ones you see on TV, like Better.com or Quicken Loans or Rocket Mortgage and all that sort of stuff, a lot of those places are kind of big companies, and I call them like it's the computer approval. They take your basic documents, your W-2 paycheck for the last 2 months and last year's tax return, they feed it into the computer, and the computer spits out a yay or nay. And the person you talk to on the phone can't really do much for you. So for a lender like that, it might be a little more challenging if you don't have a standard job with a certain amount of, regular, easily verifiable income. But in those cases, and that's the case for me, like I'm a business owner, consultant, and also a real estate investor, so I have a lot of real estate, so and I have multiple businesses, so it's confusing. There are lenders out there that are more what I call manual underwriters. It's an actual person you talk to that knows what underwriting is. They know how to look at your file. They know how to like read between the lines. They know how to present the information to the kind of powers that be, the higher people up in the underwriting system, and make the case for you that like, hey, if we just put the paper in, kind of without any explanation, it would probably come back no, but let's look at this. And I've had loans, that I went to, like a similar place that I mentioned and got declined. And then I went over to like my usual investing style lender and got approved. Now, granted, some of those lenders, they charge a little bit more fees, not that much more, but like, they might have an origination fee of like $1,200 versus maybe $400 for Quicken Loans or whatever. So maybe you'll pay a little bit of extra fee for that kind of more personal service. But if you're concerned about it, or you've had a problem with sort of a super conventional lender, there are other options. You can seek them out, and you'd be surprised that like you can actually go get approved from over here, even though you got declined over here. And there are some other aspects too of that process. Like most people have probably heard of Fannie Mae, and it's kind of like another government agency that inevitably will buy loans off of lenders and then do various things with them, like make mortgage-backed securities or whatever. I don't know that much about those details, but they have very specific guidelines. So if a lender plans to sell your loan to Fannie Mae, they're going to be very persnickety about certain things. But some banks that are direct lenders will say, well, hey, this will be a portfolio loan for us, meaning the loan will remain at our bank. We won't sell it on to Fannie Mae, and it's only subject now to our internal underwriting, and it often can be just a little bit more flexible and like a little bit more forgiving, especially if you're a business owner and whatnot. And then the last point I'll make on that is just how people understand how they evaluate business owners and folks like that is it mainly is going off of an average of your last 2 years' tax returns. Okay, so that's the basic thing that they're going to look at if you're a business owner and you don't have a regular W-2 paycheck. So they're going to go to your tax returns. They're going to look at, your adjusted gross income for the last 2 years. They're going to do an average, and then they're going to kind of look at that against the monthly carrying cost of the property and see if, they generally don't want a debt to income ratio, to be more than like 45%, meaning your debt coverage isn't more than 45% of your adjusted gross income.
Yep.
Now, the other thing about business owners, I will say, is business owners enjoy the ability to take a lot of deductions, that the average W-2 person isn't able to take. And that's wonderful when you're doing tax planning and you're trying to save on taxes. You want to take advantage of whatever deductions are available to you. And obviously your CPA tells you what is. But if you deduct a lot of things and you get your taxable income down very low because you're like, oh man, I'm actually going to save on taxes. I get to deduct this, that, and the other. Well, that can hurt you when you go to get a loan. So I would say if you're looking to get a loan for something in the next year or two, when you're doing your tax return, don't go bananas on your deductions, because with everything you deduct, you reduce what is called your adjusted gross income inevitably in your personal tax return. And you don't have to deduct everything, if you don't want to.
Well, that's an interesting tip there. I mean, I guess I was under the impression that depending obviously on how your business is structured, whether you're a sole proprietor, an LLC, or otherwise, people that are listening that own a business, you're probably somewhere in the spectrum, either 100% owner's draw, paying yourself, or paying yourself some sort of salary plus owner's draw or straight salary altogether, right? But is not only looking at the revenue and net income for the business itself, but is there taking a factor in of how much owner's draw you took in those last 2 tax years as well to say, this is how much I paid myself?
It's not so much that. It's the way it works. Whether you're like a sole proprietor, independent contractor, meaning you don't have an LLC or a corp, and you just get paid, you get a 1099. In that case, you're considered a business, basically. You report your income and expenses but just on your Schedule C or whatever on your personal return. But if you have an LLC or a corp, you might do a corp return. But at the end of the day, the net result of your business activity, so your net profit, is going to filter its way down to your personal income tax return.
Got it.
And there, it's going to basically boil down to kind of an adjusted gross income for your personal
take-home pay.
Your personal pay, or personal income. So I think, and I'm not an underwriter, but just in my experience of doing so many loans, I feel like that's the primary place, and underwriters are going to start. But then they are going to look at your business history. They always like to see businesses improving every year. So if you're going to get a loan this year or in early 2022, and they look at your 2021 year and it was much worse than your 2020 year on your business revenue or whatever, just gross revenue, they're going to be like, well, what's going on there? That doesn't look like a good trend,
Right.
So they do like to see your business obviously always going in the positive direction. But primarily, I think they're first going to look at your adjusted gross income. And it's kind of like when you're especially an independent, like a sole proprietor or a single member LLC or a single owner S Corp, it's like your business and your personal are kind of one system, It's not like your business is getting approved for the loan. You are.
Right. Well, and from what I hear you say there, I mean, those manual style underwriters, they're just trying to evaluate risk. So they're seeing if you are a good gamble or not to provide a loan and that you will pay off that loan plus interest, right? They will eventually make money off of this transaction. That's bottom line what they're trying to figure out. So when it comes to finding that type of lender, I think what I hear you say is really choosing your lender wisely. Would you get those recommendations straight from your realtor, or is there somewhere else to find these types of smaller, shops that are and mortgage companies that are out there?
Yeah, I mean, it is kind of a little bit of a word of mouth. You could ask your CPA and just say, hey, my deal. I'm a business owner. I don't have the W-2 thing. Do you know any good lenders that understand how to underwrite for business owners? So you can ask your CPA. You could ask me. I have a couple that I work with. If you email me, I'll email you their names. One in particular that's done most of my loans for my investment property. So it is a little bit of asking around. Now, I also try, though, like I said, if something like the more conventional lender, like the fees might be a little bit less there, right? The closing costs or whatever, or maybe they don't have, any, lender fee at all, whatever. Try to get pre-qualified there too. You don't have to pre-qualify with one place. You can pre-qualify with multiple banks because they all, the interest rates are always, they're similar within probably a quarter to a half a point. But some will be a little less than others. Some will have a little different pricing on the points and stuff. So it's like you're kind of shopping around, when you get pre-qualified for the best loan you can get.
Right.
So if you can get pre-qualified with an easy, conventional lender that is, has lower fees, go that way. But
well, and I think it's interesting to me as well. I mean, talking at the top of our conversation of like, well, if I just put 5% down, I could potentially qualify for $500,000 home. But the reality is, it's not until you get that pre-qualified letter do you know actually how much house you can qualify for.
That's right. Yeah.
Right? So then that adjusts the goalpost, if you will, of how big of a house or the price of the house as well. And then I think it's kind of reverse engineering from there. And you go, oh, well, I could only qualify for X as my loan. So then, it's a matter of going, okay, I've got $25,000 cash that I can put down now. What if I put a savings plan together to save 50 and pause the home buying for maybe 3 or 6 months and save that amount? Like, so then the things start to even out or simplify altogether. And
honestly, it might be 6 to 12 months even before you found something and buy something. So you start looking, I would say start looking before you think you're going to buy, just go check it out. Even if you go for a weekend or two and kind of get your feet wet, learn the lingo, yada, yada, yada.
Yeah.
And,
get
get the wheels in motion.
Like what stuff costs, right, in your area. Yeah.
The challenge in trying to have a higher down payment is good in a couple of ways. Obviously, it brings your ongoing monthly payment down because your loan is smaller. But where the challenge of having a very low down payment is that when you're making your offer and you say that I'm only putting 5% down and you're competing with an offer that's putting 20% or 50% or God forbid all cash, it feels to that seller like, oh, maybe they're on the borderline, of maybe getting approved for this or not. And so is it riskier to go with them even though they were the first people to the table or, even though I like them or whatever. So having a little bit of a higher down payment, maybe in the 10% range, I think is going to benefit you in that sense.
Sure. Well, I mean,
so just something to consider, but it shouldn't stop you. You can get a loan at 5% down, and it depends on the market, and it depends on how competitive that the market is you're in and stuff like that too. But just I would say don't let all these things like psych you out.
Right.
You know what I mean?
Right.
It's like it's an important thing to do. It's a worthwhile thing to do. Nothing worthwhile in life is easy. So just go out there and try to get it done because you're going to be better off in the long run in your life for a variety of reasons, in my opinion, if you do it.
And I can say without a shadow of a doubt, having a solid realtor who you trust implicitly is worth its weight in gold. I mean, I've purchased and sold quite a few houses over the years, here in the U.S. and also in the U.K. And you can't do it without a realtor. Don't buy the hype of like, oh, people are buying houses like hotcakes. I don't need a realtor. Like, why would I pay them whatever? And for me, I think
I'll say this
false.
On that. As a buyer, it costs you nothing to have a realtor because the commissions all come from the seller. So number one, always have a buyer's realtor. But I will say today that the realtor used to help you find the house before, right? And they do that a little bit still today, but everyone's on Zillow. You can nearly access almost the same thing they can access on your own. So you might say, well, why do I even have to deal with a realtor? I got to call her or him and go out there and meet them and whatever. The reason these days realtors are awesome and good ones are great is that they're trying to add more value because they understand what I just said. So they're helping you a lot more through the closing process. Like they're educating you on the documentation much better. They're helping you schedule inspections. They're helping you schedule getting other subcontractors out there. Like they're doing a lot of legwork for you. I mean, I feel like in the last couple of houses I bought, the realtor almost did everything I asked. I'm like, can you call an inspector for me and get that set up and meet them there? And they're like, yeah, like they really, kind of in a way working for their commissions these days, I have to say. And if you get a great one, like you said, it's like it really takes a lot of stress and anxiety off the whole process. So
yeah, they can help you negotiate or at least coach you through the process. They can be that project manager to help you if you are a seller, managing all of the, repairs and things that need to happen before you go to sell. But also on the buyer's side, showing you here are the next 10 steps between offer and close so that you're not just bumbling through it, or worse, making decisions that affect you financially, in the long run. Yes, I have two really great realtors, one in Dallas area and one in the Austin area. I'll put their names in the show notes. If those are two areas you're thinking about, get somebody local who knows the market, knows their stuff, and you will be so thankful and grateful for it.
And I'll add to that, because I learned this kind of the hard way. A buyer's realtor, so someone that's working with a buyer, different animal than a selling realtor.
Yes.
Okay, like if you say you bought your house with X person and now you're going to sell your house 3 years later, don't just call X person and have them sell your house. When you're selling your house, you need to interview at least 3 realtors that focus on selling, because selling's the hard part of real estate. I mean, I guess buying is a little hard these days too, but buying is more about paperwork, getting your offer and whatever. But selling, if it's done poorly, can cost you a lot in sale price. And there's a lot of psychology involved. There's a lot of great preparation that needs to happen. Someone needs to have good design style. They really need to pitch your house well to get top dollar. And not any agent, will do that. And just because they're your friend, don't go with them necessarily.
Yes.
Like, you just got to say, I need to get the most money for this house as possible, and I got to make sure I get the right person for the job, and I'm not just going to give it to my buddy or my mom's, person that's him or whatever.
100% agree. That's a very good point. And, we talked about at the beginning is, thinking about and actually doing the math behind this. Obviously the pros and cons of renting versus owning. I know you've got a spreadsheet for that, and we'll put a link in the show notes for people so they can download that freebie from your side. But what would you give us as a couple of tips on planning out your finances really long term, and not even just thinking about the house buying process, but also like including your retirement plan as well? Like, how do we make a start there?
Well, I'm glad you brought this up. Doing the math is really important. I say about myself as a person, I'm a person that does the math, and you can do the math on just about anything. Sometimes it's a little sad to do the math in certain topics, but
but necessary.
But I think the big challenge people have right now, especially people that live in like Los Angeles, San Francisco, these markets where just real estate prices are bananas. They're asking themselves, like, is it worth it for me to buy something that's so expensive?
Yeah.
And that's a really fair question. But the truth is, you can do the math on that. Basically, you can say, well, I'm paying X number of dollars in rent today, and very likely if I keep renting, my rent's going to go up such and such over time.
Yes.
This is what that price of a potential, equivalent housing is in my area. And as you mentioned, I have a spreadsheet that basically does a comparison. Like, where would I be in 30 years if I kept renting, under these conditions versus if I bought today at this price, and I kind of actually have some metrics for future conditions. What if the house appreciated at this rate versus this rate? What if I took the money that I would have put in as a down payment for the house and invested that in the stock market today, and it got a return of 10%? I factored all those things together, and I basically then kind of look at the comparison of where you would be. And generally speaking, the math is pretty compelling for buying. Just on a numbers front, and like I kind of calculate, like my standard calculator kind of has these numbers in there. Like you're paying $1,500 a month today. What if you bought a house for $300,000? Where would you be in 30 years if the stock market returned, an average of 8% a year, and appreciation was 5%, but your rent increase would be 3%. You would be like many hundreds of thousands of dollars, like $500,000 plus richer if you bought the house.
It's wild. Yeah.
But if you're paying $2,500 a month in a rent-controlled apartment in New York today, and you don't plan on moving, and you can manage to live there for 30 years, that compared to buying $1 million one-bedroom condo, I have to say, as much as it bums me out, financially speaking, you do better staying in the rent-controlled $2,500 a month apartment.
Right. Well, but the truth is that Manhattan is one place that's like 0.0001% of what the real estate market is in the U.S. It's not common in, say, places like Texas or Kansas or otherwise. Yes. I think that the bottom line that I always remember when renting a house versus actually living in a house that I own is that when I'm renting, I am paying down somebody else's mortgage.
Yeah.
Like, bottom line, that money, if you add it all up total, if you're there a year, 2 years, or 5 years, you have now just paid down their mortgage with all of that money. And that's where things
to show for it.
Yeah, that's where things get a bit sad, and you go, that's a down payment. Like literally a down payment of a house.
There's some controversy over this topic, and it's like weird. Some very well-to-do, wealthy people seem to be on the side of renting, and I'm just like, I don't know what you guys are talking about. But I look at it like this. I'm very black and white, and this is how I kind of do the numbers on it. I don't consider myself so much a homeowner. I consider myself a renter of a piece of real estate that I own. Okay, because that's really the comparison you're making. What if I kept just being a renter and didn't own the real estate? And what if I kept being a renter but decided to be a real estate investor and I just rented to myself, who would be the best tenant in the world because I don't need management, I don't need to check if the house is looking good, I don't need to do all these things I actually have to do with a regular rental property. Right. And that's kind of how you do the math. You're basically like, how does the house end up performing with me as a tenant, paying X number of dollars of rent, and knowing that my rent's never going to go up? Because that's one of the other big benefits of owning. It might seem expensive today, like on a monthly payment basis, but that generally is not going to, your monthly cost is not going to go up, as significantly as your rent will. Your insurance will probably go up, with inflation. Your taxes will go up a little. Certainly. Well, it depends what city you live in too, how quickly your taxes go up. But it won't go up as fast as, your rent will increase. And if you move sometime in that 30 years from like a smaller place to a bigger place, well, your rent's going to really jump because you're going to move to a bigger place and you're going to move to, market rate rent. Whereas maybe if you've been at a place for 3 years, maybe you're paying a little bit under market. So that's something to consider. And then the other thing I like to say to people, because this is a big complaint people have, or like worried, they're like, I don't want to be house poor, and I say, don't buy into the house poor argument, okay? I feel like you should be perfectly fine with being a little house poor. The reason is because with every bit of your mortgage payment, a good chunk of that is going into a savings account that is the equity of the house.
Correct.
So owning a house is a forced savings account. And there's nothing better for your long-term financial future than a forced savings account. So it's like, your mortgage payment might be more than your rent today, but a lot of that extra payment might be going towards the equity of the house. And you need to, calculate that, do the math on that, see what the real reality is of that. Also, don't buy into you have to pay for repairs and you don't have to pay for that when you're a renter. Don't buy into that either. It's like, do the math. You can get reliable average costs on repairs and home maintenance, factor that into the math and still see where you'll truly net out.
So, yeah, I imagine a lot of first-time home buyers, and, I was one a long while ago as well. The biggest loan you've ever had, besides maybe student loans from college, is your car loan. And you go, okay, $20,000 or $30,000 on a car loan, and I'm paying it off bit by bit by bit by bit. So the institutional data points in your head is like, oh, you buy this thing, it depreciates immediately as you drive it off the lot, and that's what buying big stuff on a loan is like. But a house doesn't depreciate the second you buy it. It goes the opposite in most cases, right? So you have to kind of reprogram your brain, and that's where, kind of squashing that fear of like, oh, I'm going to take a loan for how many zeros underneath that number?
Mm-hmm.
Like, oh, it's a big, scary thing. What would you say to kind of squash the fear? Is it really empowering yourself by doing the math?
Yeah, I mean, well, people I think are pretty familiar with the phrase, there's good debt and there's bad debt, okay? A home is good debt. Real estate is good debt. What makes good debt good is that you borrow the money to go do something, buy a house, and a house in a sense is a business. It's got income and it's got expense. It produces a positive net cash flow, and it produces long-term appreciation and eventually a complete internal rate of return.
Yeah.
But it's a functioning business in and of itself. So you're borrowing money to go start a business with the plan that that money is going to produce more income than the cost of the loan, right?
Right.
So it's a positive cash flowing business. That's good debt. Bad debt is your car loan where, like you said, it depreciates like the vast majority in the first 3 years after you drive it out the lot. It produces no income for you.
Right.
And ultimately, it's just a big, giant expense that you'll never recoup. And you're going to be paying for now over 6 years instead of buying a cheap car that you can afford all in the year that you bought it.
Right.
So real estate is good debt, and for some reason, when you talk to like anybody and you're like, well, is investing in real estate a good idea? And most people are going to be like, yeah, pretty much. Like most of the real estates in the world be that because of their, real estate, blah, blah, blah. Everyone will make a positive case for real estate. But then for some reason, owning the real estate you live in somehow falls in this debatable, category. And you're like, why?
Yeah.
I mean, it's just real estate, just like anything else. You can calculate the total return on it. You're just the renter. That's all,
Well, and if you're looking for more insight on this, so Joe has a ton of good quality content on his website. It's called playlouder.com. And side note, why did you call it Play Louder?
Well, like my wife and I essentially, you mentioned we're sort of in this semi-retired state. We used to own businesses in Los Angeles in the entertainment industry, obviously, with the Emmys and all that. And we worked a lot. We really loved it, but we worked a lot. But it paid off, But then we had a kid and we were working a lot still in the first 3 years. And we were just like struggling to sort of make it all make sense in our mind. We're like, we have this kid now, but like we can't get home. Like it's just everything's stressful. Like we don't feel like we're being the best parents, And so we just decided to blow up our lives and like figure out if we could get to some cheaper place, work less, have more free time or play time. That would be great. And so when we were starting, and then we decided to do a blog and kind of me start sharing all my personal financial wisdom and what have you. And just in brainstorming about it and with that whole, lifestyle change in mind, we kind of came up with our slogan, I guess, which is work smarter, plan better, play louder.
Love it. Well, so you can find financial, business, and real estate advice over at his website, playlouder.com. We'll put all the links in the show notes as well for how to connect with Joe and his team via social media and all of that also. Now, Joe, you have 3 online courses that are free for people to check out. Can you tell us a little bit about those as well? And we'll put that link in the show notes as well.
Yeah, what like my overall philosophy on success, I guess, I consider it to be like a 3-pillar approach. I call it being financially prudent, business-minded, and investing focused. Those are the kind of the 3 pillars to success, I call it. So I have some courses in each of those pillars, but each one has a free course where you can get, a good amount of information in some of my spreadsheets. And one is focused on real estate investing because that's been the primary way we've invested our savings. We've done obviously some stock market too, but even still, like 75% of our money is in real estate. It's been good to us. Owning a business and being entrepreneurial has been a big contributor to our success for a variety of reasons. And then also being financially prudent, tracking your income and expenses, treating your personal life like a business, focusing on your saving, and then knowing I need to save this much every year, and it needs to make this kind of return every year so I can get to my goal. And actually, you have to have a goal. You can't just be like, retirement's my goal, You have to have a more defined goal. So I have an intro course in each of those pillars and how to further yourself in those departments. And then you try to bring them all together. They all kind of work as a 3-part system, at least in my experience.
Love it.
Judgment.
Great. So all of that over at the show notes at thesimplifierspodcast.com. So Joe, I have a few questions as we wrap up that I like to ask everybody that comes onto the podcast. My first one is this. What is one book or blog that you're reading these days that's either inspiring you or poking holes and challenging your belief system?
It's this book. It's called The Lost Science of Compound Interest. I'll be honest with you, I didn't know this person from Adam. It's written by a guy named Curtis Ray, and he has a company, and I don't have any association with him except that I've met him and I like what he's saying. But he kind of, in the same way as I did, saw some issues with just modern retirement planning and the concepts of how you get to retirement and just the flaws, the seemingly obvious flaws in there. And I would always think about these things, but I was like, well, we use the tools that are available to us. Well, he set out to try to create a new tool that he thought maybe would be superior and produce better results. And he writes about that in this book. So this book is honestly a pretty detailed brochure for, his invention. But he talks a lot about investing, a lot about what the flaws are and the kind of conventional thinking and wisdom of retirement planning, and what problems you're going to run into if you don't really think about it thoroughly. So
brilliant.
He covers a lot of that in this book. It's fascinating to me, being a finance person. It would probably put a lot of people to sleep, but that's not a good reason to not listen to it. Okay.
Well, I was going to say, that just sounds like a perfect book to read at night.
Yeah. If you want to fall asleep, read the book. No.
Read a chapter, let it seep into your subconscious, fall asleep and dream about compound interest.
But it gets you excited, actually. Cool. If you're into the planning stage of your life and you're thinking, I gotta get serious. I'm in my 30s, whatever. I gotta get focused. I want to retire someday. I want financial independence.
Yes.
I want what all the blogs are pitching and all that sort of stuff. Well, it's a good book to read, whether you contact him for his thing or not.
Good.
So there you go.
Great. Well, we'll link up the book in the show notes as well. So tell us, who's one person, somebody that you know personally in your network, who is just up to brilliant things? We could shine a spotlight on him, and who knows, maybe one day we'll have him on the podcast.
Well, I don't want to take the easy route on this, but I'm going to give it to Curtis Ray. I have to say. I talk to a lot of people in the financial world, and now I know him because I'm vetting his product for investing my own money. And I'm actually working on a big blog post where I go through the whole vetting process with him, Q&A, everything. I'm really kind of excited about it. And I was kind of excited about him and for him that he kind of sought out to make something new that addressed just staunch, kind of heels dug in process of retirement planning. And I know it sounds boring. I wish I had something maybe more exciting, but that's what I read recently, and I'm kind of impressed by him. So.
I love it. I think some of our most popular episodes in the last season have been on money management, wealth management, thinking about our retirement plan. Because, the best time to save for your retirement plan was probably yesterday. The second best time is starting today. As small as it is, it will compound over time if put the systems and processes in place.
The more time you give it, the less money you need to save.
There it is.
That's the truth. And I will say this. I want to end on this, because I sadly, I talk to a lot of people that are in their late 30s, 40s, and they're finally realizing that they have to get together, and they're a little bit behind, and it bums me out. It's never too late, so It's good that they're getting to it. But I really think it's important for people. Retirement's kind of a sleepy term. I feel like the kids call it financial independence today. I like that a lot more. It sounds more exciting.
Yeah.
But you can't get there if you don't know where you're going. Like you have to map your route and you have to have a very specific destination in mind. Like you can't just leave it to chance. Just don't be like, I'm saving, I'm putting $100 a month away and hopefully it works out. Just don't do that. Don't do that because I don't want you to be 40 if you're in your 20s and be like, I should have put more thought to this 15 years ago. I'd be so much more ahead, And it's not that hard to do. I have like free stuff, that free course I mentioned. I have a calculator in there. It helps you figure it out. Like I map it out. Just take the weekend,
do the thing.
Yeah, have some drinks and figure it out.
Yeah. So I believe gratitude and simplicity go hand in hand. Tell me, what are you grateful for today?
Well, we actually do a lot of gratituding around here at the house. So we have a gratitude jar. But I mean, in general, I'm just grateful that I have more free time, frankly, to like spend with my kid. And that is possible because I did the work, I did the math, financial planning and thought ahead and just took it seriously. It's your future. Don't cheat yourself, by just being like, I'm not a numbers person. It bores me. I'm going to go do this or that. It's like, just devote a little bit of time to it every month. It's not that tough.
Yeah. So that's smart.
Great in general.
So again, the website is called playlouder.com. Joe, thank you so much for your time today. My final question for you today is this. Someone somewhere is listening to us right now, and she is literally about to buy a house. She's maybe already figured out her down payment number. She's maybe even gotten pre-qualified. She's already got her sights set on some neighborhoods, and maybe even she's even gone to a couple of open houses. But she is crippled with fear, trying to figure out how to make the perfect offer or to get the right house and not lose the opportunity. What's one thing you could whisper into her ear right now just to encourage her in this moment?
I would say think about this as your first of many real estate investments. It's not going to be the only one you make. It shouldn't be the only one you make. It's going to be a great stepping stone, but nothing is perfect. It'll never be perfect. The best thing to do is commit, get going, and then trade up. But just don't be super precious about it. As much as you want to be, it's just the first step in a long journey.
Joe, thank you so much for your time today.
Yeah, absolutely. Thanks for having me.